Hello everyone, welcome back to another chapter, chapter 4, that is analysis of financial statements. In our chapter 3, we understood what are the components of financial statements and what are the individual items presented in each component of the financial statement. Now we are going to analyze those items to make decisions from financial manager perspective as well as investors perspective or outsider financial statement users perspective. Let's move on. um, the chapter have more or less same information, I mean all related to financial statements, but the thing I want to focus is this. We have 5 categories of ratios, and each category actually gives some sense of particular aspect of financial health of a company. For example, liquidity. By liquidity, we understand that how much company is able to pay its short-term debt. Meaning, if any short-term debt is due very soon, then and then asset management. This is all about how a company actually is efficient in utilizing its fixed assets, current assets, or sales revenue. I mean, to generate more profit. On the other hand, debt management ratio, this is all about how the company's total asset is financed, whether it is more of debt uses or more of equity uses or a mixture of these two. Then profitability, meaning the accounting performance of a company, how changing particular unit of the item of income statement actually will have a positive or negative impact on our profitability margin, return on equity, or return on asset. Then market value, the last one, actually this is going to be used by investors, who the potential investors who are thinking to invest in that company. So they consider how much price earning ratio or market to book ratio, meaning how that company's stocks are valued, or how other investors actually consider paying the companies for per dollar is or per dollar earnings for a particular time period. So these 5 categories actually will help us to analyze financial statement, and each category will have some separate financial ratios. So that ratios formula, I should say, this is our formula sheet for chapter 4, analysis of financial statements. In this chapter, in this formula sheet, we have necessary formulas to analyze our financial statement. I don't know whether we have some categorization. So the 5 categories of ratio we just talked about in our PowerPoint slides. So this individual formula actually will fit into those 5 categories of ratio analysis. So let's see our practice problems for this chapter. So the class practice problem actually involves reviewing this ratio: days sales outstanding, day to capital ratios, market to book ratios, ROA, ROIC, and current ratio. And for this one, let's open a new Excel spreadsheet. Chapter 4, analysis of financial statements 8. Let's here you go. This is your formula. Okay. Now problem 1. Say problem 1. It says Bexley Brothers has a DSO, day sales outstanding of 22 days, and its annual sales are this much. What is its accounts receivable balance? Assume that it uses 365 day in a year. Round your answer to the nearest dollar. Okay. So first of all, we need to know the formula for DSO. So DSO, let's go to our formula sheet. DSO. So DSO, DSO, receivable by average sales per day. So can I just say DSO equals receivable divided by receivable divide what is divide by sales by 365. So this is our formula. Now okay, let me get the values first from the problem. DSO equals 22 days, sales equals 6,570,000. Then okay, these two, and year days in year is 365. As this problem is telling us to use 365 in a year. So the question is to ask has the accounts receivable is what? So these values actually I got from the problem. Let's make them yellow, and this is our formula. How you can get it? So we have values for DSO. There's this. We have values for account receivable. No, we don't have it. So that's our question. And we have sales divided by this one. So if this is our formula, then how we can get account receivable? So next line, can we just say since this is multiplication form, then it should be in a induction form. This times this, $396,000 would be our account receivable. I can say it's, let me mark in green color. Okay, let's go to see our problem 2. P2, get the values from the problem. Case kitchenware has market to book ratio MB ratio is 1. Then stock price is $12 per share. Then shares outstanding is 4.8 million. Then total capital this means actually the total asset 110 million. So let's get our balance sheet, asset, liability. So total asset is this one, liability, total liability and actually owner's equity, OE. Would be the same. This one, liability includes okay. actually um, capital investment. So this should be the equity portion. This should be the owner's equity. Owner's equity would be price per share times number of shares outstanding. So this is our owner's equity. Then liability, I mean debt, would be this minus this. So this is our calculated one. Everything actually calculated. So you just need to provide your choices here. Then as the debt to capital ratio. So this is our debt and this is our capital. So then DE would be this divided by this. Done. 0.901. Oh, I'm sorry. Capital is this one. I am sorry. Debt divided by total capital one. Total. So 0.463. You can make it in percentage form like this. So this is our final answer. Then problem 3. Problem 3 is some EBITDA. Let's guess the value from the problem. The total assets is 17 billion. Total assets 17 billion. Then cash equivalent is 100 million. Then liability, current liability is 1.7 billion. The notes payable is 1 billion. Payable is 1 billion. Then what else? Firm has also 10 billion long-term debt. Long-term debt is 10.2 billion. Then common equity. Oh, this is and common equity. Say common equity. It has 300 million shares common stock outstanding. Share outstanding is 300 million. Then stock price is $20. EBITDA is 136 billion. And then assume firm's debt is priced at par. The market value of its debt equals to book value. What are the Edelman's market to book ratio and its economic value to enterprise value to EBITDA ratio? So two things we need to calculate. One is MB ratio. Two is EV by EBITDA. So these all we get from our problem. Okay, I think the problem it has some problem. So it should be 5.1 million in common equity. So this is not CE. C is 5.1 million, 1 billion. 5.1. Not, no. This is our common equity. Okay, now What's the book value? If we get to our formula, book value is common equity divided by share outstanding. Common equity, number of common equity, volume of common equity is this, divided by share outstanding. So 300, actually I should write 300 of the 300 10 million, so I should give a full number. So this should be $17. Book value calculation done, so should be marked in green color. Then what else? Market to book. Now MB ratio. Market to book ratio is the formula what? Market price per share divided by book value per share. So this is our book value per share and market price per share. So market price per share. This is market price per share divided by book value per share. 1.18. If I make so like this. So this is our market to book ratio. Then EV by EBITDA. So how is our EV by EBITDA? EV by EBITDA equals market value of equity plus market value of total debt plus market value of other financial claims minus cash and equivalents divided by EBITDA. So this, if I copy a big formula. So market value of equity. How we can get market value of equity? Sorry, equal sign market value of equity, meaning stock price per share multiplied by share outstanding. This is market value of equity plus market value of claim other claims. So market value of other claims is what? So market value of other claim equals long-term debt plus notes payable, then minus cash and equivalents. So cash and equivalents, this one, it should be rounded up and then divide by EBITDA 12.5. So this should be our second part, or even I don't need to mark this one because this is not our main result we want. So this two would be the answer. Okay, then problem 4. P4. A company has EPS $2.40. Book value per share is this. Let's get the values. EPS is $2.40. Then book value is 21.84. Then M ratio is 2.7 times. Okay, so this is our values from the problem. Now what do we need to do? What's the price earning ratio? PE equals what? Price to earning ratio. What is our price to earning? Price per share divided by earnings per share. So EPS should be the bottom, price per share. How we can get price per share? Price per share should be this book value per share times market ratio. 58.97 would be price per share. Then this divide by EPS. So 24.57 times would be the price earning share, meaning per $1 of earning, investors are ready to pay $24.57. Then P5 is what? Okay, we have one more question. Let's get the value from the problem. Income, NI NI is 24,000, then interest expense is 5,000, then tax rate is 25%, then notes payable is 27,000, then long term debt is 75,000, then common equity is 250,000, and then if firm finances with only debt and common equity, so it has no preferred stock. What are the ROE, ROE, ROIC is what? Is what? So these values we get from our problem. Now ROE. How we can get ROE? What's the formula for ROE? ROE equals a lot. Net income by sales times sales divided by total asset times total asset by common equity, or ROA times equity multiplier, or profit margin times total asset turnover times equity multiplier. So let's see. So use the third formula, net income by sales. So these sales cross total asset, total asset cross, so ultimately net income by total common equity, ROE. Can we just say net income by common equity 0.96, or percentage form it should be like this. Then ROIC, return on invested capital. Return on invested capital, how you can get it is okay. So return on invested capital equals EBIT after tax operating profit divided by total invested capital, debt plus equity. So debt plus equity, EBIT, how much is our EBIT? So if net income, EBIT, we need to work on it. How we can get, say, income statement. Income statement, how we can get EBIT divide by, interest expense, then EBT, then tax, then NI. So our NI is this. Then if tax rate is 25%, so it should be this divide by 1 minus tax rate. This should be our EBT. Then interest expense, interest expense is $5,000. This should be 5,000. Then EBT should be this 5,000 plus 32,000. So this is our EBT. Okay, EBT. Now ROIC is the formula, EBT. So EBT is this times 1 minus tax rate, then divide by debt plus equity. So how much is our debt? Common equity is this, long term debt is this, 27 is this. Debt is this, notes payable plus common long term debt plus common equity, this. So this should be our return on invested capital percentage. Seven point 80%. So let's make them color. Okay, our last problem is P6. This is, let's get the number from that. Stewart company has $2 million current asset, current liability, inventory this. It will raise funds as additional notes payable and use them to increase inventory, how much can its short-term debt increase without pushing its current ratio below 2? So let's get the value. Current assets equals, current asset equal 2392500. Then current liability is 1076625. Then inventory is 526350. And current ratio is, they want to actually maintain below 2. Okay, so how much can its short-term debt, I mean particularly notes payable, increase without pushing its current ratio below 2? Let's see how is the current ratio. What's the current ratio formula? Current asset divided by current liability. So this should be current asset divided by current liability. 2.2. What's the minimum changes we can do to make sure our current ratio is less than 2? Or exactly equal to 2. So this plus notes payable, changes in notes payable, we can say change this in NP, then divide this plus changes in NP. Equals 2. Just minimum criteria. Then how much we can try? I mean we can have changes in NPV. So I want to play with this model. How I can show you, say the first part, C95 plus changes in NPV equals 2 times C96 plus changes in NP. If I do it correctly, then if I say C95 equal, then it should be 2 times C96, then it should be 2 times changes NPV. I mean it should be plus sign, I'm just multiplying. Then this one, can I just say C95 minus 2 times C96 and then equal signs here, it should be 2 times changes NP minus changes NP. In other words, if 2 changes NPV, notes payable minus only changes NP, then we have only changes in P. So then can you just see C95? C95 is this, current asset 95 this minus 2 times current liability 239,250. So this should be our max we can do. If you give this as value derived from problem, and then you get the values from here. So these all from our chapter 4. Hopefully it will be helpful for you, and just I'm telling you, go through this formula sheet and see how you can apply it to solve your Sangaja assignment problem. So thank you, good luck.